Well, good morning, everyone. Welcome to our Wednesday morning trading session. My name is Eric Senft. I'm going to be your host here this morning. Just a moment while I get the screen share going on for you. For those of you who are new to our trading room, welcome. What you're looking at here is the diversified trading system. And it's diversified because we're looking at the market from 3 different points of view. Here across the top, we have the Hawk Scalper. Through the middle, we have the Falcon Swing Trader. And across the bottom, we have the Eagle Trend Trader. The charts you're looking at here are the NASDAQ. I'm also following the E-mini S&P and crude oil. But please don't be shy about requesting a market that you might be interested in. I'd be happy to pull it up for you if I can get it on my data assortment. Regardless of the tool that we're following, all the signal generation occurs the same way. Namely, we're going to get this warning dot along with an audio alert. Then when the signal parameters are met, we're going to get a triangle and a hash mark. Ooh, I should actually get on board this one here. Let's see if I can't get that one. It's very early, but let's see if we can't perhaps run this trade out a little bit. Now, what I'm going to do is I'm going to delete my profit objective and my break-even trigger. So we have a signal here where everything is in sync, and this is kind of your standard signal for the DTS system. We've got a warning dot. The signal completes when we get the triangle and hash mark. That means it's decision time for us. And we generally look for the signals to be in sync. So what I mean by that is we've got red trend lines, red bars, red signal, red filter. Now it's still very, very early. It's only a couple of minutes into the session. So this is a very aggressive posture on my part. Oh, look at that. They're waffling here around the 48.70 mark, which I believe was a pretty popular number yesterday as well. So this is the Hawk Scalper, as I mentioned. The tool I'm using here on the right to enter the trade, this is called the Trade Manager. The Trade Manager has 2 very important components. First off, it has this risk component. There's 2 modes, the risk percent mode and the manual mode. Manual mode will default to the quantity up here. The risk percent mode, however, defaults to this value right here. So this means that currently I am risking 2% of my capital, regardless of where I place my stop. So the Trade Manager will adjust my position size relative to where I place my stop. So if I place my stop really, really tight, I'll be able to trade more contracts, but the risk amount is going to stay the same. Now here for this opening trade, I chose to leave the stop a little bit further back because it is the open, and I'm not entirely sure what kind of follow through we're going to see here. So far, so good. By the way, we have hit our high probability profit objective. Had I left that in play, we would already be in a profitable position. But I find that sometimes for the first trade of the day, we can get a little bit more mileage by trying to run it out. The second component of the Trade Manager is this up here. This is called what we refer to as the Profit Manager portion, and it is an assortment of 16 different stop strategies that are all fully customizable. So currently I've got the ATR strategy selected. It's going to look like this, these little blue dots, and as I mentioned, you can make it tighter or looser, whatever the case may be. Oh, don't tell me I should have taken my profit when I had it. All right, we're getting a little bit of a pullback against us here. What the trade manager will do is once I activate it, I haven't enabled it yet, it will follow this stop strategy automatically. So it will manage this trade for me according to the stops. So let's say we'll go here to yesterday. So we had a first micro macro cross right here. The market gave us a little bit of heat. You can see how the stop strategy would have held you in for the better part of this move until you finally got stopped out down here. All right, so hopefully you'll see a little bit more of that. All right, now we're getting a recommitment to the short side. I'm going to go with a swing strategy here. Oh, all right. We'll go with the swing strategy. I'm going to enable it, so what it's going to do now, once the swing strategy, you see the parameters have been met, so it automatically brings my stop down now for me. And it will continue to manage the trade this way as well. All right, let's see what else we have going on. Let's take a look here next at the Falcon. The Falcon relies heavily on this trend line that goes through here. So when the trend line is green, we're looking for buy signals. When it's red, we're looking for sell signals. Same kind of situation though. We're normally looking for signals where everything is in sync. So here we have a trend, what we call a trend change signal. So the trend line changes color, goes from red to green. This is essentially the first signal where everything is in sync. That would be a buy signal. So you see green trend lines, green bars, green filter. Now notice if I set my stops down here, note the risk amount. That's 2% of my capital. If I place my stops tighter, okay, a little bit of a rounding thing going on here, but 2% of my capital is around a $400 risk. But notice the quantity has changed. I've got 3 contracts in play here, whereas if I risk it below the lows, I'm only going to trade a single contract. So the trade manager protecting your capital while also optimizing your earnings. The horizontal lines you see through here, this is the ultimate support and resistance suite. It's an assortment of 21 support and resistance lines. These are forecast for today's trading. And you can see they're doing a pretty good job containing the market. The gold line is the median line. The blue line above is primary resistance. The blue line below is primary support. These have a tendency to set the tone for the day. When the market gets above here, it's going to be a little bit more bullish. When it gets below here, it's going to be a little bit more bearish. But right now, we're kind of stuck there. Oh, by the way, these lines, this is what we call a system add-on. It's a fancy way of saying it's a standalone indicator. So you can use it on any kind of chart you like, whether it be a 5-minute chart or a tick chart. It doesn't need to be a DTS chart, although it is part of the DTS system. And last but not least, we have the Eagle Trend Trader. The Eagle uses this trading band through here to give us our directional bias. So when the band is stacked this way, we're looking to buy. And when it's stacked the other way, come on, gotta go back here a day or two. There we go, we're looking to sell. No, this is not an Ichimoku cloud. This is, I know it looks like one, but it's not one. It does respond in a similar fashion to the Ichimoku cloud in that whenever the market encounters the hard edge of the cloud, we anticipate a reaction. So you can see the market came up there, hit it, fell off a little bit, hit it again. Oh, now we're actually getting a counter trend signal, what we refer to as a rule of 3, but more on that in a moment. All right, I think I heard that we got tagged. Yes, we did. We got stopped on that reversal, but that's okay. You know, trading is it. I'm going to show you something that nobody, no other trading room moderator shows you. This was a losing trade. Well, it was a losing trade only because of the way I managed it, I suppose. Had I taken the profit when I had it, you can see we would have hit our profit objective. But I chose to try to run it out. That was my decision. But note that we never had more than 2% of our capital at risk. In fact, this is closer to 1% because this is on a $20,000 account. But we even rolled our stops in. So even though we got tagged here for $125, that's less than 0.5% of my trading capital. Those types of trades, albeit unpleasant, are not going to ruin you. The kinds of trades that are going to ruin you are the ones where your risk is disproportionate to what you can afford. Notice I said nothing about your risk relative to your reward, which is going to be an odd concept for many of you. It's your risk relative to your account. Many people trade far too much risk, far more than they can afford, and then they wonder why they blow up their account. And they think it's because, oh, I had the wrong setting on my stochastics, or I didn't use my RSI right, or I need to get that new fancy Bollinger Band application. Nope. I hate to tell you, that's not it. So it was a good signal, but it was a bad signal. But it was a good loss. Ooh, I like that. There you go. In order to be good at trading, you have to be a good loser. You have to be able to take your losses well. And by that, again, I mean, like we did here in this hawk trade, we started up here. We got stopped out. I could have rolled the stops a little bit here off of this reaction. I considered it. I considered rolling my stops down, perhaps changing my stop strategy to maybe I could have done parabolics. And I would have got stopped out here for about $100. But regardless whether I got stopped here or I got stopped up here, the risk was still an amount I could afford to lose. Like I said, very important concept, and one that most traders are never able to wrap their heads around. Well, we got a dead flat sideways market here this morning. I'm just going to check the reports calendar because what is holding us back here? Nothing. Let's take a look here. Steve says, yeah, there's no reports going on. Oh, sorry, Powell, FOMC member Powell speaks in a couple hours' time. That shouldn't be that much of a hurdle for the market this morning. All right, well, we'll put that away. Steve's asking, he says crude oil looks like a runner this morning, maybe. Well, let's take a look here. So let's start with crude now on the Hawk. So the overnight, very active for crude. Crude opening here 6 a.m. Pacific, 9 a.m. Eastern. A lot of waffling, a lot of movement back and forth. At the moment, we're producing a first micro macro cross, which is a buy signal. Oh, Steve said, "Oops, sorry, he meant gold." All right, we'll take a look at gold in a moment too. But we are getting a buy opportunity here in crude oil on the Hawk. Cindy says OPEC reached a deal this morning. All right, well, we'll see how that holds. It wouldn't be the first time an OPEC deal fell apart. Here, crude oil out of the open, yeah, right up here. We got a trend change signal right here, so a nice decline. Hit the secondary resistance line, almost right on the number. You can see we bounced off of that one. Went into a tailspin to this one. Now we're working a possible trend change signal higher. So right now the Falcon and the Hawk in sync with each other. And let's take a look here at crude oil now on the Eagle, and we had a trend change signal right here shortly after the open. Honestly, that one would have been a little bit tough to take. I'm looking at this. We've got what we refer to as a rule of three signal. Now, don't be concerned that you don't understand what these signals are. We go over these signals every day in the trading room. But, well, I guess we did kind of have a test of the extreme. The test of the extreme is always the tip-off that the market is going to try to go the other way. And all the test of the extreme is really is a retest and a failure. And normally it looks like this, where it goes up, the market comes up short, and then you get the reversal. Occasionally, the market will break through slightly, as it did here, and then reverse. The point is that even though it broke through, it did not follow through. That would be our rule of three signal, which is a counter trend signal. But if you missed that, you did get the trend change signal occurring right here as the band turned over. And now it's as though crude oil is trying to manufacture a rule of three to the upside. We've already got two counter trend signals, looking for that third one. All right, and we'll take a look at gold here in a second. Oh, they're going to try to short again, are they? We're right back here now with that first micro-macro cross signal again. We're seeing some pretty aggressive trading going on here this morning. All right, I'm going to try to show you the trade manager again, how it actually rolls the stops automatically. So I'm going to delete my profit objective. There we go. All right, we're getting a little bit more. There we go. All right, so when the market starts to move like this and I start to get a little bit more open profit, I like to go with a little bit more of an aggressive stop strategy. We'll go with the ATR. So we're currently at a break-even type situation. If you wanted, though, well, we've got almost $100 on the table there. We could even go with something more aggressive like the parabolics, but we'll see if we can't get a little bit lucky here. And I'll get to that gold chart in just a moment. Bo writes, why is the NQ misbehaving in the last 2 or 3 weeks, moving erratically, especially around the New York Open? It's becoming difficult to predict its directional bias. Oh, I hear you, Bo. One thing that we have been doing relatively successfully is here on the Eagle. We've been taking the first in sync signal. Now, I didn't do it this morning, but it would have been this signal right here, this green bar sell. So we've got green bars, we've got a sell signal, we have a bearish band. So there's our sell signal. Just for argument's sake, let's say I took it on the hash mark. You can see that we had a decent signal, decent follow through on that. And that's been a bit of a lifesaver for us, like you say, the last 2 or 3 weeks. Here was yesterday's session. Here was the opening signal right here. Again, it's a sell signal with a bearish band, so it's in sync, and it too found our profit target. I'll just show you one more day, and then we'll get back to the day. So here was the open signal. See, the market opened around here somewhere, but this was a sell signal, but you see the band was bullish. Here's a buy signal. This is what we call a red bar buy, red bars with a buy signal. Bullish band. I probably would have risked it at least to there, even below the low if I could have afforded it. And there we go. So the Eagle has been working pretty well for us that way. It isn't, well, this one worked out as well. I was going to show you one. Here we go. Here's one that didn't have a lot of follow through. This is about a week or so ago. So a green buy signal, bullish band, stops would realistically go at least below the hard edge or at the hard edge at the very least. And the market makes a rally up, Now, honestly, after this second rally up, I would start to think about rolling my stops in. So I would probably bring my stops in here somewhere, effectively cutting my risk in half. If you didn't, you got one more chance, and then the market started to unwind. But once again, even if you don't touch your stop, you manage your risk correctly, right? You cap your risk. Oh, Andrew says, Drat, I missed it. That might be the move of the day. I sure hope not. I hope we're going to get a little bit more. Bo asks, just the first valid opening signal? Yes, sir. On the Eagle. The Eagle is the one that's been giving us that nice signal. And Russell, one of our DTS owners, brought it to my attention. He said, hey, Eric, I've been watching that opening Eagle signal, and so long as it's in sync, it tends to have some pretty decent follow-through. And he was right. I really got to get more active on it as well. So you can see we've bounced here off of the primary resistance, held up a little bit here at the median line, and now we fell off to the primary support line. If we break through there, we're likely to go two zones. So next stop, 48.54 quarter, after there, 48.44 half. That's where we would be looking. All right, let's get down there. Just gonna make sure I didn't miss anybody's question. Nope, looks like we're good. Hey, Jim! Buongiorno! You're back from your trip. Jim says, good morning, Eric. Long time. Oil is a lot of fun with those bots today, 30 to 40 in 8 seconds. Yeah, it's been a little bit of a crazy market, all right. Oh, here, we're going to look at gold. Because Steve mentioned gold this morning. And yeah, some pretty crazy ranges. Funny thing is, though, here on the Hawk, it's too bad this yellow bar spoiled the signal. That's unfortunate. But I have a feeling we got it on either the Falcon or the Eagle. You see, the programming for each of these tools is different. So even though you may not generate a signal in one of the tools, you'll certainly generate or pardon me, you may miss it in one of the birds, but you're going to get it in one of the other ones. Steve says, I've got the Raptor. Okay, well, the Raptor is a little bit of a blend. So you're going to incorporate elements of all three. But the nice thing about gold really is that it truly is a world market. It is traded 24 hours a day. So regardless of your time zone or your daily commitments, you can always look to gold for trading opportunities. So you can see here around the London Open, we got a nice little macro pullback and a sell signal. Then we got a rule of or 3-arrow consolidation, nice little move lower, followed by a first micro macro cross and another move lower. And unfortunately, this one did not meet our parameters. That darn yellow bar spoiled it. But now we're coming back with yet another first micro macro cross. So we'll see what goes on with the gold market. That's the Hawk. Here is the, oops, stop it. There's the Falcon now. And, oh, that signal that I mentioned that we missed on the Hawk, it's right there on the Falcon. So we got a, what we call a late filter entry signal here on the Falcon. So the swing trader picked it up. Nice little bounce here off of the secondary support line. Tried to break through this secondary support, got rejected, and so it's looking like gold going to head down here to 1173.50. Let's see what they've been doing in the overnight. Right here out of the, or just prior to the London Open, we got another sell signal. Like I say, gold, really a 24-hour market. You can trade at any time. Nice little trend change signal right here during the Asian session. Not much follow through, but a decent enough signal. Enough to hit our high probability profit target anyway. And last but not least, let's take a look here on the Eagle. And we got a nice green bar sell. Remember I said whenever we encounter the hard edge of the trading band, we expect a reaction. These green bar sells, that's a high probability trade for us. You got green bars with a sell signal. It's almost as though the buyers tried to sneak up on the sellers, and all of a sudden the sellers said, uh-oh, what's going on here? We got to push this market down. Okay, Moses says he's having some trouble getting a hold of Adam regarding the support and resistance suite. All right, Moses, shoot me an email. I'm going to give you guys my email address. And I'll make sure to forward it on to Adam. The support and resistance suite is an add-on for those of you early DTS owners. The support and resistance suite is now part of the DTS package. And now, it's not that you missed out on anything. The current pricing reflects the inclusion of the S&R lines, but it is still something that you can add on from the website. All right, so we're working a trend change signal here, kind of fighting with the primary support line. If we get below there, we should be golden. They're struggling a bit, though. Get down there. All right, let's see here. So our hawk trade working out pretty well. And again, let your pocketbook be your guide. If we can get one more little push here, I'm going to move to a parabolic mode, which is going to protect more of the open profit. The bar high low strategy and the parabolic strategies are the two most aggressive strategies that we have. But again, even these are adjustable. Nice thing is, if you want to preview what the strategy is going to look like, you can hit the preview button. And you can say, oh, see those orange hash marks? That's where the parabolic is going to be at. And if you say, yeah, I like that, then click accept. And now you will be running the parabolic strategy. Come on, just one more break. There we go. There we go. Oh, here we go. A little plug from Jim. Jim says he thinks the support and resistance suite, those are these lines, and the indicator warehouse dynamic equivolume bars, he said those are a must. The dynamic equivolume bars, you probably noticed that some of these bars are printing thinner, some are printing fatter. For those of you unfamiliar with equivolume charting, equivolume attempts to show you the volume associated with each bar by painting higher volume bars wider and lower volume bars narrower. Now, what might surprise some people is that when the market is trending, it's actually trending on relatively light volume when it's actually moving. It does take volume to make the breakout, because you see there's a lot more bars here than, when the market turned. There's fewer bars. But when the market is actually trending, the volume is relatively light. When these bars get thicker, that's where the buyers and sellers are starting to dig in. And you can see this one coincided very nicely with the primary support line, as did this one here, coincided with the median line. So when you see those things happen, then you can normally anticipate a reaction. So here, the buyers got stronger, the market went up. Here, the candle got wider, the sellers got stronger, the market went down. Here, the buyers got stronger, but the sellers came right back. See how these bars are a little bit fatter. So far, the sellers seem to be controlling it, but just barely. They're not really getting a whole lot of follow-through at the moment. So we might get another little hiccup in here before the market tries to continue lower. Now, this was the sell signal here. This is what we call that the trend change signal. I'm already short on the Hawk, so I'm not going to go short again here on the Falcon. But that begs the question, well, where would you put your stop? Well, ideally, the safest stop is above here, above this swing high. I know it seems like a long ways away, but remember, I was going to say, remember Trade Manager controls your risk, but did you see what happened? Trade Manager says, nope, sorry, Eric, at 2%, you can't afford it. So the Trade Manager is always looking out for you, right? It's keeping you from overextending yourself. So if I wanted to take that trade that way, I either need to dial up my risk amount. So generally speaking, anything less than 5% is prudent. Let's say I want to risk 3% of my capital. Okay, I could do it at 3%. Or I choose to pass on the trade because I can't afford it, which is a viable action. Or I cover above the median line. So I use the support and resistance lines to help me cover the trade. And that's a viable option as well. So we're still kind of floundering here a little bit. The parabolic's creeping in, and we're probably going to get tagged here. You see the bars getting a little bit wider again. So obvious support around the 48.60 area. $48.70 yesterday, a real obstacle for us. Okay, and we got tagged there on that little bit of a reversal. So a solid signal, decent follow through. And that's really all there is to it, folks. Yeah, see, Jim says he uses the equivolume with the block trades on the time and sales to see areas of interest. Yeah, you're going to, anytime traders get busy at a level, and you can tell what those levels are, even by looking at your chart, right? Every time the market swings like this, it tells you there's a lot of buying and selling going on right at that price level. And same thing down here. This is obviously where the buyers got busy and the sellers were no longer willing to sell. Buyers got busy, buyers got busy. Now, even though these prices are not exact, they're essentially the same price, right? Traders are interested in buying that price. They're interested in selling this price. This is how a trading zone is born, a trading range. It just kind of gets stuck. Well, Jim says the advanced decline is pretty dead even too. 1480 on the buy and 1330 on the sell. So, yeah, no bias as far as the advanced decline is concerned. Shane is asking, hi Eric, can we look at some currencies please, like cable? Cable. That's slang for the British pound US dollar pair. Trading lingo. Gotta love it. Yes, absolutely. Just a moment here. I will load it and bring it over. Oops. My data series, the data provider I'm using now doesn't provide the pound US dollar pair, but I can get the 6B, which is the futures. And the 6B should be identical, or it will be identical to the uh, pound US pair. All right, and Tony, which market would you like for the Raptor? The NQ? Okay. All right, so bear with me just a moment, Shane. I will get you the pound US pair. This is the Raptor. Tony says he needs to compare it with the Raptor, a blend of the other tools. This tool right here is quite interesting. This is what we call the Geiger counter. The Geiger counter is essentially a tape reader. So it gives you a visual of the time in sales. It's going to print a tape here, a histogram. You can see the current bid and ask and who is stronger in the marketplace. And right now you can see this dial is dead neutral. Seller's trying to pull it over. When it pulls and sticks to one side, oh, there we go. See how it's holding and holding and holding? It's kind of bearish. Ooh, it's holding there for a long time. Sellers are chewing through some of those sell orders. We should see a little bit of a downtick. Oh, here come the buyers again, trying to offset that. All right, Tony says he's good to go. All righty, let's put that away. So the pound now, the British pound. Here is the British pound on the Hawk. Really? Oh, I may have to go to the alternate settings for the pound. We should have got a signal through here. Bear with me just a moment. Let's see what yesterday was like. No, yesterday was okay. It may just be a fluke. We'll check the other birds here in a moment. Yesterday, the British pound London session opened right here. We got a first micro-macro cross signal, one of our high probability signals, and really good follow through. My goodness, that could have made your session right there. And then came back with a macro pullback signal here. Took a little heat on that one before it finally chose to rally. Oh, I see. The first micro-macro cross occurred right here about an hour before the London opened. Oh, we did get a red bar buy that we could have shorted also. I forgot about that. So the red bar buy signal, it's a little bit different than the one on the Eagle. On the Hawk, the red bar buy tends to develop near the end of the trend. So for that reason, you can treat it as a counter trend signal and you can actually look to short it as well. So that would have got you in on that one. I missed that. And now today we've got a macro pullback signal, which is a buy signal for us. So this is about a couple hours before the North American markets open. So a nice little scalp through there. And now we got a sell signal, a first micro macro cross to sell. And a nice little scalp through that as well. So the British pound still trying to get a little rally going on, but they keep getting knocked down. That whole Brexit thing really putting a wrinkle in the pound. No, the Falcon didn't pick it up either. It tried to right here. You see this bar? This bar was trying to produce our trend change signal, but it didn't. We did get a trend change to the upside right here. I don't know if that got to our profit objective or not. Let's see. Oh yeah. Hit our high probability profit target and then reversed. This does tend to happen a fair amount of time. The market gets to the high probability target and then turns on its heel. And now we're working a sell signal. So there's the trend change signal to the short side. You could cover it up there, and well, we're still working that one. Below the secondary support now, it looks like our target is going to be down here, 124.18, approximately. You need to remember too, because these lines are forecasts, they're predicted, the market may fudge it by a tick or two, or it may come up short a tick or two. Now, a lot of times it will hit it bang on the number, but it's okay if it misses it by a little bit. Like I said, they are predictive. And this is the eagle for the British pound. We didn't get a signal there either. Technically, in hindsight, you can call it a rule of three signal, but honestly, when it was unfolding real time, it would have been a very difficult signal to get a handle on. But we've retraced practically the whole way and came back with a green bar sell, so you can short from approximately the same price, and it looks like we're about halfway to our profit objective there on the British pound. Yeah, no problem, Shane. Shane says, thanks, Eric. Anytime. If there's any markets you're interested in seeing, please don't be shy to ask. So that eagle signal, big follow through this morning. So there's that first eagle signal I was talking about. Easily finds our first profit target. Could have even split the trade because there were two contracts. Could have taken profit on one here and tried to run out the other one. Wow, fantastic. That's a fantastic move. Okay, so while we were perusing, we had look at this, we had a late filter entry signal. A very high probability signal here on the Falcon. The late filter entry signal occurs when the filter goes out of sync, comes back into sync. The trend line, however, never changes color. Very high probability signal. Almost as good as money in the bank kind of signal. Now, again, I wouldn't squeeze my trade too tight, even though the DTS system is very good at picking up immediate momentum. Honestly, I would probably throw my stops above the median line. We're kind of struggling here with the primary support. Broke through, no problem getting to the high probability profit target. And you could even use your support and resistance lines as profit objectives. As I said earlier, it's likely to move two zones. So it's reached the first line, 48.54. Next stop, 48.44.5. Although I might start getting out around the 48.46 area. I don't want to be the last one out. Oh, way to go, Tony. Tony says he's still in with two runners on that late filter entry signal. Nicely done, Tony. That's going to be a good payday for you. Well done. Nylish says on that eagle, is that the third signal? It is, but that third signal on the eagle that I mentioned earlier, that is a counter trend signal, that rule of three. Now, when you're taking, so for instance, some of you might be looking at this and say, well, why aren't you looking to buy off of one of these signals? You got lots of buy signals here. Okay, there's two things that you need with a rule of three, or any counter trend signal. Let me be specific. With any counter trend signal, there are two things you need. First, you need a trend. Second, you need a retest of the highs or lows. So in this case, I suppose you could make a case that that's your downtrend. But really, most of this downtrend was quite bullish already. Right? It wasn't like we had a downtrending band. We did get a test of the extreme right here. The extreme is the low, that point right there. So, you know, you could look at it and say, well, we had our retest of the low. Why aren't we buying one of these signals? Well, I think it's primarily because we don't really have a downtrend yet. Let me find you a better example of what that rule of three looks like. Sorry if I'm making you dizzy here. Oh, here we go. Okay. So because it's a counter trend signal, it's going to develop at the end of a trend. Once again, first requirement is that you have a trend. Now we're starting to print counter trend signals. There's a buy. There's a buy. At this point, I'm starting to think, maybe this trend is starting to unwind. I need to be on the lookout for a retest of the low and a failure. After all, this market is in a downtrend, right? Every move lower should push the market lower. But what happens? It stalls and comes back with yet another buy signal. Our rule of three is now complete. Now, one thing with any counter trend signal, you don't have to buy it immediately. You can wait for the first with trend signal, which looks like it occurred right around here. You're really not giving up that many ticks in order to gain a more probable entry. Right? And so then you can buy, taking some heat, but the market eventually goes up. All right, so anytime you're looking at a counter trend signal, remember, first you need to have a trend. Can't have counter trend if you don't have a trend first. Secondly, you need to retest the extreme, whether it be the low or a high, and you need to see that failure. That's a wild move. That's just crazy strong. All right, I'm curious now. Oh, by the way, you can also click your targets if you like. So I'll show you how that works. Just out of curiosity, I'm curious how far this market has already moved today. So right down here, oh, we're up about $600 per contract. That is a massive move out of the open for the NQ. Hey, way to go, Steve. Steve says, my second day in the room and $885 today. Fantastic, Steve. That's incredible. He says, the NQ was my friend. Love the money manager. Well, you know, folks, at the end of the day, we're all going to pick some bad trades. It's how you manage those trades. It's how you manage your exposure that's going to make the difference. Yesterday, for instance, I got myself a little bit behind the eight ball, took a couple stink bomb trades, but I caught a nice move in the afternoon and managed to fight my way back to I was still in the red, but it was minor. But the whole point again is you need to manage your trade so that when you do take that loser, you don't wipe yourself out. Don't cripple your account. Right? Tony says 4840 was a huge number from a couple days ago, and we're likely to see a reaction there. So we've encountered our secondary resistance line. Once we break the primary support, or to the upside, the primary resistance, as I mentioned, the market does have a tendency to move two zones. So a lot of people like to use the support and resistance lines as a way to set your profit objective. So you could have come down here and you could have set your profit target at the support and resistance line. And there you go, picked up a tidy little profit. And now we're getting a little bit of a reaction. Yeah, it's like Dan says. Dan says you have to believe. Yeah, you have to trust your tools. It's sometimes easier said than done, but really that is the secret sauce, if you will. Good morning, Mark. Mark says could be a fib retracement of the uptrend. It's entirely possible. Hold on a second here. I'll build a different chart so we can see what Mark's seeing. Oh, I see. Yeah, Mark says I was looking at your chart. Just out of curiosity, though, here's a daily NASDAQ chart. And for those of you that like to mess around with the fib levels, so there, that looks like a feasible objective for the market. Get back down here near 4,800. A little bit sideways though, right? The whole market looking a little congested. Yeah. Nylish says, the problem is there's too many tools and they mess with your head. That's why we went to great pains to make the tools easy to use. There's not that much subjectivity in the signal interpretation. Sometimes, you know, there's a little bit. You're going to choose sometimes where to place your entry. Like, for instance, This signal right here is a 4-arrow consolidation, what we call a 4-arrow consolidation on the hawk. I might not take the signal right on the hash mark. Rather, I might choose to enter below there. And by entering a little bit later, I could probably get by with a tighter stop. But note how much I'm giving up, almost at least half of my profit objective, almost 3/4 of my profit objective, just to gain entry. So in that case, maybe I would be better off just biting the bullet, taking the earlier entry, and boom, down she goes. See, as I mentioned, the DTS system is very good at picking up immediate momentum, but this is what you don't want to do. And I know this is what most people do, is they jam their stops in ultra tight. The market brings you in, stops you out, and then goes on without you. Don't think for a second that this didn't happen on purpose. There's minimal market manipulation in the stock indices, but everybody knows traders are going to jam their stops in tight. The breakout traders, the weak traders, if you will, the guys that are selling here, and girls, I'm not going to leave you ladies out of this, you're at fault too. But the ones that get short on the breakouts and they put their stops in ultra tight because they're afraid. So this is where the trade manager is ultra important. Note the risk amount, $385. Now don't freak out if that seems like a lot of money to you. That's 2% of my capital. Watch what happens if I put my stop, say, above that swing high there. Oh, it's the same amount. But what has changed is the quantity. What if I put my stop way up here? Oh, went a little bit too far. Let me try that again. Oh, it's the same amount. But what has changed? The quantity. But which trade has the highest probability of success? Which trade is the most likely to work out? The one with the stop right here or the one with the stop right here? Well, obviously the one with the bigger stop. Now you may say, well, I'm only going to risk a single contract, so I'll get stopped out for $60 and you'll get stopped out for $370. No, not necessarily. First off, it's extremely unlikely that the market will make a beeline up here and not give me at least one chance to get out. It can happen, but it is very unlikely. When that does happen, I still have not lost more than I can afford. But the chance that you're going to get tagged here for $60 or $70, whatever the case is very likely. It's very likely you are in very tight on this trade. So what if you get tagged 4 or 5 or 6 times before you hit a profitable trade? How is that different than running one stop for $370? It's not. Besides, this is not a loss until it gets hit, right? That stop loss is only there to protect me. It's my safety net, my parachute. When you're falling out of an airplane, you want to make sure you have a parachute. When you're jumping over the side of a sinking ship, you want to make sure you've got a lifeboat. This is my lifeboat. Your lifeboat is awfully close to the sinking ship. Having a little fun with this analogy. Sorry, I can't help myself. Okay, so you just got stopped out, and I'm still in the trade. The market starts to go in my direction. I can now take my stop from up here, and I can roll it down to there. So while I may have started with $400 initial risk, now I have about $100 on the table. Again, not that different from your scenario where you started with about $60. you got tagged, you owe commission and fees, you're probably up to around $70, $75 anyways. I've got $100 in play, and best yet, I hit my profit objective. Now the real difference occurs when there's perhaps a little bit more structure in the market, and I can perhaps take a trade like that. Because now, instead of just trading singles, I'm maximizing my earning potential. Sure, you may take your little trade and only risk $60 on your single contract, and you get stopped out because your stop is too tight. But let's say you even leave your stop back here, and you manage to ride out this swing. You're still trading a single. You've made $50. I've made $100. So not only are you likely strangling your trades and getting stopped out prematurely, or even worse, risking more than you can afford to lose, but when you win, you're probably not maximizing your earnings either. You've all heard, cut your losses short, let your profits run. Well, that's great advice. Too bad nobody shows you how to do it. Well, that's how you do it right there. Cap your losses, maximize your earnings. That's really what it means. Cut your losses, let your profits run. And yet most people do the exact opposite, don't they? They max out their losers and they minimize their winners. And then they wonder why a year later they have no money left to trade. And they blame the market. Frank's asking, would you short the NQ again? I would, off of the right signal. The problem with shorting the NQ right now is the stop. We have to allow a very generous stop. This right here is a macro pullback signal. It is a high probability signal, although I will point out that we typically only see 2 macro pullback signals within a trend. So it is very likely that we will see some sort of retracement, and for that reason I'd have to cover the trade up here. Now you can see Trade Manager says, no, sorry Eric, you can't afford it. The macro pullback signal, by the way, occurs when the micro line goes out of sync. Everything else stays in sync, but the micro line changes color. Well, I think I just missed crude inventory report too. Oh well. Well, doesn't look like much came of it. It is crude inventory today, isn't it? Wednesday? Yeah. 10:30? Yeah. That is odd. So I'm all for shorting the NQ, Frank. It's definitely in a downtrend today, but the problem, as I said, will be holding on to the trade, being able to hang in there against any pullbacks that we might see. And a pullback is likely because, as I pointed out the other day in the trading room, let's say you are a fund manager and you're trading a fund, and let's say you've got, 30 orders in play here. And we're going to say that you're going to run a profit target, or you're going to put everything on as a runner. So you see I deleted my profit objective. Everything shifted over here to the runner side of the equation. So your trade started off like this. You've got over $7,300 in play, and now the market's down here, and you're thinking, well, I should probably lock in some of that profit. So let's say you take, we said this is around $600 per contract. Let's say you take 20 contracts off So you're banking profit on 20 of those contracts, so about $12,000, and you're going to roll the other 10 to break even. That profit taking is what's causing this little bit of a pullback. It's not to say that the trend is going to outright reverse today. I don't think we're going to see that. At worst, we might see the market drift a little sideways. But this is what's happening right now is the bigger traders, they're saying, okay, we got like 10, 12 grand in profit. Well, actually, on all 30 contracts, you've got like almost $20,000 in profit. So let's protect some of that. So they'll peel off half or 2/3 of their position, leave the other third to run out. They'll at least leave their stops at break even. So it's a winning scenario for them. They can't go wrong. But when that happens, that's when we see these little characteristic pullbacks. And, they end up being, in this case, it would be like a bear flag. And it's just a matter of waiting them out until we get that next signal that the market's ready to move lower. But you can see I couldn't afford to do it on the hawk. Let's see if we're getting a falcon signal. No, the last falcon signal we had was right there, so we're not getting a sell signal on the falcon just yet. In fact, we're getting a buy signal on the falcon. This is a counter trend signal. Now, when I consider a counter trend signal, I almost always dial down the risk amount because it's counter trend, right? Nice thing about the counter trend signal, this is our trend change signal, is that we can cover the trade below the low. And I would definitely take my profit on target. Oops, what's with that? Oh, it says at 1%. I can't afford that trade. Oh, I can just squeak it in. So again, you see how the trade manager protects you. Okay, Bo and Mark, you got great questions here. I'm going to get to both of them first. Bo asks, is it ideal to risk 30 ticks or just 10 ticks or 15 ticks? You're kind of coming at it from the wrong angle, Bo. What you want to do is you want to cap your risk at a certain dollar amount. Ideally, like I said, 5% or less of your trading capital. So let's say, for instance, you're trading a $10,000 account. That means that no trade should have more than $500 at risk. Ideally, you want to set up your trade so that it's fundamentally sound. And by that I mean, if this is your buy signal, where, fundamentally speaking, is the best place to put your stop? Well, probably not right there, because that's well within the market's current range, isn't it? You could put it right here. You could say, well, the market's tested the 48-43 area twice and rejected it, so I can place my stop there. Okay. But it's going to cost you $500. Right? That's 5% of your $10,000 account. Or you could put your stop down here, which is still going to cost you $500, by the way. But from a fundamental point of view, it's a little bit better, don't you think? It's a little bit more sound. After all, if we try to buy and the market reverses and stops us out below the low, then we can say without a shadow of a doubt, I was on the wrong side of that trade. Now, as I mentioned, with a counter trend trade, especially in an obviously strong downtrend, I wouldn't go too crazy. I wouldn't risk 2%. I would probably just risk 1%. just throw a single on there. If it works out, great. If it doesn't, okay, well, I've lost 1% of my capital. On your $10,000 account, that would be $100. A $100 hit is not going to ruin you. The $1,000 hit, the $1,500 hit, that is what's going to decimate your account. So you can see you've got a high probability signal. We're taking it. We've got an opportunity to work this trade, even though it's counter trend. Here, I've got a second chance to get in it. So let me sim this for you. So we're going to enter here and put our stops right down there. Now, if the market holds this low again, then I can say that, all right, the buyers are in control. I can start to roll up my stops. But there's a very good possibility the market may break this low by a tick or two and then reverse and go up. Don't think for a moment that buyers and sellers don't know where your stops are. The people that bought here, their stops are right nearby, right? They're right down here. And as a buyer, if you're buying with a limit order, where are you going to buy? Well, obviously you would like to buy down here. You get a better fill. Why should you buy here? You're going to buy down here. I'm looking for momentum, right? I'm looking to simulate this order right here. So the DTS system looks to capitalize more on momentum. Traders that trade limit orders look to try to buy the lows and sell the highs. Now, the problem with a limit order is that you're going to try to predict what the market's going to do next. And that's not always so easy to do. My own personal preference is to react to what the market is doing. If the market is going higher, then, or it looks as though it's putting in a bottom, then I'm going to look to try to buy. Which brings me to Mark's question. Mark asked, do you think the pullback could be liquidity vacuum forming from a lack of limit orders after a strong downturn? Yeah, I think you're right. So what Mark's suggesting is, okay, we've seen the market fall off, pause a little bit here, fall off some more. Sellers are obviously not interested in selling anymore, or not as much as they were from up here and down here. So the sellers are waiting, and they're sitting back and they're saying, all right, let's see if we can get 48.64 again. If the market comes back to 48.64, they'll be all overselling it. But they may not be so interested in selling 48.50. Right? Because if you sold 48.50 and you think the market could get back to 48.64, where do you have to put your stops? Well, probably at least above here, and that could be a little sketchy. What if the market trades 48.66? Right? Then you just took a big hit for all this amount through here. No, the buyers and sellers can each make money on the trade. So even the ones that sold down here, thinking that the market is going to continue lower, they'll continue to sell. They'll sell up here again, and they might lose some money on the first one, but they'll make some money on the second one and essentially walk out of the scenario with a break-even type trade. Same thing with the buyers who bought here. It wasn't us because our trend line was red. But there were buyers who bought here. Well, they're buying down here too. They've lost money on the first trade, so they've lost this amount, right, on the first trade. And now they're looking to make profit on the second trade, maybe get it up to there. And between the two, they kind of offset each other. Maybe not entirely, but pretty close. And actually I can even draw that down there. This is why these 50% retracements tend to work. Right? The markets react at 50% levels, and everybody says, oh, it's magic. It's a Fibonacci sequence. No, it's the buyers exiting their losing positions and their profitable positions so that they can get out at break even. That's what causes the market to react around the 50% level. But that's a very, very good observation, Mark. All right, so we're just going to nurse this Falcon signal along now. And if I can get a bar or two in my favor, well, our break even is nearby. I'll let the break even trigger engage, and with a little bit of luck, we should even find our profit objective. As I said, a little bit of profit taking would not be out of order here today. Come on. All right, Mark asked me yesterday if I would demo the magic mouse again, so this is a good time. So the mouse is actually a tool. It's still in beta testing, but if you push your price bar like this, it will actually make the market move higher. So we'll just watch this here for a second. Mark says, that's awesome. Here, we'll give it a minute. Come on, get up there. Give it a little push. There we go. Come on. A little bit more. There we go. Here, we'll encourage it a little bit more. Tony says, I hope you have the patent on the mouse. Yeah, once we get it perfected, we'll make it available to the public. Come on, get up there. Trading has just dried up. All the volume has gone out of the market here. Again, you can tell from the width of some of these bars, like 263 on that. Compare that to some of the volume we saw here. Like there's 3 times as much just on that bar. There's 4,300 contracts traded there. This current bar, oh, it's not bad, 1,100 and counting. Come on, get going. There we go. Oh, Shane says the pound Aussie dollar pair is making a move. I can get some of the Forex pairs, but they're on my delayed data feed. I got a freebie data feed from Kinetic, but it's delayed 10 minutes. So I could look really smart if I put the pound Aussie pair on the chart now and then showed you how it would make a big move. But you'll have to tell me whether it's higher or lower, Shane. I can't believe crude oil is dead flat after crude inventory. Let's take a look here. This is crude oil on the Hawk. Inventory came out right here, and you can tell from the timestamps This all unfolded in about less than a minute, a few seconds, just exploded on the chart. But look at all these yellow bars. The yellow bars on the hawk tend to print when the market is in a choppy phase. And you can see on your filter as well, it looks pretty much like a tartan. So it's definitely a sideways market. That is a little bit surprising. We don't always see big moves out of the crude inventory, but we normally see some sort of move. Well, here we are. Frank says, looks like the eagle is going to try another short signal. Yeah, now it's producing off the soft edge of the band, and it's currently against our ATR. The squiggly red and green blue line that you see here is the ATR line. And we kind of use that as the filter as well. Oh, that warning dot's disappeared. I suspect we're going to see a pullback here to the 48, 59, 60 area. That's where the hard edge is at. That seems like a very plausible move. Problem with the eagle, even if we produce a signal here, and even if we take it before the ATR syncs up, where do I cover this trade? So we've got swing lows there, more swing lows there, swing high there. That seems like the minimum place that I could put the stop. Oh, I'm still trading 30 contracts. Let's try that again. Yeah, see, a trade manager says, no, you can't afford it. Forget about it. And sometimes you have to, right? There's always going to be another opportunity. There's no point in risking too much money. Don't be in a hurry to lose money. That's a good way to look at it too. Okay, the NQ definitely in a downtrend, however. And the safe bet is to short. But like I said, the problem is stop placement. Being able to hang in long enough to realize a profit. Oh, come on. Get up there. Crude oil unwinding a little bit to the downside, but I think they're just kind of hunting for stops at the moment. Yeah. Tony says somebody hit the snooze button. All right, boys and girls, we'll hang with the market here for a few more minutes. Yeah, I don't know. Mark says, is there anything in the market causing the consolidation? Nothing that I know of, other than the market is very content to be trading around the 48.50 area. Buyers and sellers both agree this is a fair price for the NASDAQ. Believe it or not, here's the crude oil chart. This is a very happy market. It's not the kind of market that makes us happy, but the market is very happy. Crude oil traders are very content to be paying $48.50 a barrel for crude. That's why the market refuses to move away from here. It tries to go a little lower, it comes right back to $48.50. Tries to go a little higher, it comes right back to $48.50. Some traders refer to this as barbed wire, and you can see why. And just like playing with barbed wire, it's easy to get hurt. But yeah, that's a very content market. Just like the NQ is right now, they're very content with the NQ around the 48.50 area. It's quite a coincidence, though, that crude oil is trading at 48.50 and so is the NQ, 48.50. If we see this 48.50 area fail, in other words, if the market continues to trade through there, I'm very confident we'll get our first profit target, and we might even see a retrace here to the 48.64 area. But now we're going to see why it's important to leave your stop a little bit further back rather than have it jammed right underneath here. Okay, so if your stops were right below there, watch the market come down here, tag it for a tick or two, and then reverse and go higher. Absolutely, Frank. Frank's asking, can you go over the click, tick, target thing in the trade manager? Let me show you here on one that I don't have an active trade. Okay, the tick targets, you can preset profit objectives. So right now I'm 100% all in, all out on target 1. I have target 1 preset at 10 ticks. Let's say, however, I wanted to split things up and maybe take a third off at target 1 and a third off at target 2 and leave the rest on as a runner. Let's say I'll make target 2 30 ticks. So I've got a third, and a third. So now when I take my trade, this isn't the signal, by the way, but I'm just going to show here. So if I take my trade and I set it up like this, I automatically get my 2 profit objectives. Of course, assuming I can get 3 contracts in play. If I placed my stop further, so I only had 2 contracts, oh. Hold on a second here. Am I in risk mode? I am. Oh, all right. This second number shouldn't be displaying. I'm not sure why that's displaying. I think I broke something. Normally what it would do, if you can only trade 2 contracts and you're splitting it up into thirds, it will take profit on the first one, but it will leave the second one on as a runner. So there must be just a slight little rounding error going on here in the programming. The click target, on the other hand, allows you to manually set your profit objectives. So let's say that was going to be your stop loss, and let's say you want your first target to be there and your second target to be here. So that's how the click targets work. You click where you want your profit objective to be. Now, once the trade is engaged and it goes live, these orders are live also, and they can be moved. So for instance, here in my Falcon trade, because the trade is live now, if I wanted to change my break-even trigger, I can move it around. If I want to change my profit target, I can move it around. If I want to change my stop loss manually, I can move it around. Well, they didn't quite get low enough. I thought they were going to tag the low here for a tick or two and then reverse and head higher, but they're going to make a liar out of me. They reversed early off the support line. Now they're going to get up there. They're going to hit the break-even trigger. Come on. Okay, you're going to see the break-even engage here, and then we're going to see how Trade Manager brings the stop up, and voila, we hit our profit target. Steven says maybe the new Steve should be calling the signals. I've not even made a trade today. That's all right, Steven. you'll get around to it. All right, folks, I'm just going through the questions here. Shane's asking for some information about the pricing on DTS. The best thing to do is send me an email. And again, I'll give you my email address. It's eric@supportandresistance.com. I'll put that in the chat window. And I'll find out, because Adam is normally very good at getting back to people's emails. So I'm going to make sure there's not something wrong with his email address. Mark is asking, do you feel that contentment in the market is, or do you feel that contentment in the market at a given price is accompanied by normal volume? Yes. Volume tends to rise when the market is rallying, either higher or lower. When the market is content, volume is relatively stagnant. So yes, I would agree with that statement. Frank's asking, can it be used with the buy market at the top, the button at the top? Yes, absolutely. Oh, not your targets. No, sorry. If I hit buy market, so I've got a long order, I've got my auto break even, which I'm going to move up here for now. As soon as I enable my stop strategy, I click enable and accept, I'll also have a stop loss order according to that strategy. And like I said, it's all adjustable. You can make it more aggressive or more conservative, or you can change stop strategies if you like. But you will not have an auto profit target when you do that. You'll have to manually enter a profit objective. Now, there is a stripped, well, I don't want to call it stripped down version. There's a different version of the Trade Manager called the Trailblazer, which will, it's a one-click entry system. It will give you your profit objectives and your stop losses. However, it does not have this risk manager component built in. So you'll need to know more or less what your risk exposure should be. Frank says, I was thinking of presetting the top buttons, then adjust the stop target, etc. Yeah, certainly you can use these to get into a trade when the market's moving really fast. I'll use them to at least get me into a position. Then I'll set my stop loss, and then last I'll set my profit objective. So there's always a way to get it done. Moses says, Eric, I was stupid yesterday. I made 400 and lost it back. Today I got 515 in gold, and that's it. I'm done. Thanks. Good for you, Moses. And I wish I could say I've never done that. I wish I could say I've never given my profit back. It happens to all of us. It's part of trading. But it sounds like you learned your lesson, so good on you. Bo is asking, so how do you calculate your net take profit when you split your trade or your take profit into 3 targets? Well, all right, let's take a look here. So we've got 3 targets, and let's say we're going to do the auto target. So we're going to enter here, we're going to place our stop here. So your first trade earns $50. Your second one earns 150, so now you're up 200. And your runner, well, it's going to be wherever your runner gets stopped out. If you wanted to do a third target, it would look like this, and you would set your third target amount. Say we're going to go for 40 ticks. So then it's 50 on the first, 150 on the second, so you're up $200 and $200 on the third, so that would be a potential $400 profit. So note that's a $400 profit by running out the 3 contracts. If we had simply gone all in, all out. Oops, stop it. There we go. Okay, if we simply went all in, all out, oops, wrong button. It's not 100 ticks. There we go. Let's go back to 3 contracts. So we'd make $150. You would still only need to do that a couple times a day, right? You find a couple scalps for $50 each, be able to trade 3 contracts on the position, and you'd be more or less in the same neighborhood as trying to run a trade out, because you can see, well, the market ran early, but now it doesn't have a whole lot of interest in following through on anything, does it? It's kind of blah. Frank asked, do I need to click OCO? No, the OCO stands for one cancels other. And the way the OCO order works, now these orders are live when you put them on your chart, so it's a good idea to place them away from your market and then bring them in. Now the OCO, these orders are linked. You'll see how it says OCO 1. If I toggle the OCO and I do it again, let's do it down here. See how these orders are matched OCO2? And I can do this all day long. I can toggle it as many times as I want and put in different OCO orders. Oh, looks like I got 2 or 3 on the same line. So there's OCO 1, 2, and 3, OCO 1, 2, and 3. If I cancel OCO 2, the corresponding buy order cancels. If I cancel OCO 3, the corresponding sell order cancels. If I bring these orders in now and I get a fill, again, I don't get the auto profit target, but if my stops are enabled, I will get a stop automatically. All right, so that's how the OCO function works. And normally I show that off around crude inventory report, but not today. And I think we'll finish out the session here with Steve's question. Steve asks, do you try to hit a certain dollar amount daily, or what determines your enough is enough? I do try to hit a profit target, and hold on a second here, I gotta roll my stop back to where it was. Stop it. So I'm going to disable that for the moment. There we go. Ideally, I like if I can make $1,000 on the day. That's my profit objective. Some days I do, some days I don't. I am a strong believer in running a trade quota. So what that means is I have a certain number of trades that I'm prepared to take in the day. You see, most people think about trading with a production line mentality. They think, oh, well, if I trade 20 times a day, I'm going to make more money. No, probably not. The problem with trading 20 times a day is it's very difficult to find 20 winners. And it doesn't take that many losers to offset all your hard-earned profits, especially if you do as I do, and you can see I run a slightly wider stop to increase the probability of my success, rather than run a tighter stop and get stopped out more frequently. To me, the end result is the same. If I have a $200 stop in play, or whether I get stopped out 4 times for $50, the end result is the same. What is different is that there's a greater probability of success that I'm not going to get stopped out too early here versus a $50 stop, which the market is likely to hit more often. Yeah, like Bo says, that's me. So what I try to do is I try to have a trade quota. Ideally, I'll trade anywhere from 2 to 4 times a day, depending on how the market is behaving. But I'll try to correctly capitalize so that at the very least I'm taking 2 contracts, sometimes 3, sometimes even 4 if the setup is right. So I'm not trading more frequently, rather I'm trying to capitalize on the high probability setups. And that takes a lot of pressure off trying to find a lot of trades in the day. If I go into the session and I know I'm only going to trade 3 times today, I can cherry pick, right? I can wait for a late filter entry signal like this one right here. If I get a counter trend signal, I can think long and hard about it. Like, is that really going to be one of my 3 trades today? Do I really want to take that one? All right, the setup seems good. I'll take it. Okay, I go up. I hit my profit target. Hooray for me. That's two of my trades out of the way. Now I've only got to find one more good trade today. So you can see that takes a lot of pressure off analyzing your signals, analyzing the market, and you can really hold out for the solid signals. The other criteria is I want to finish the trade the day in the black. So let's say I have a 3 trade quota, and let's say I take the first trade, it's a stinker, I lose 200 bucks. I take the second trade, I lose 200. I take the third trade, I lose 200. Okay, I'm down $600 on the day. I've had my 3 trade quota, but I'm not in the black. So I'm going to take another trade. I'm going to try to get out of the red, at least recover, if not all my loss, at least most of my loss. Take some of the sting out. So let's say I take the next trade, and I may try to stretch it a little bit more because I'm trying to make a little bit more money. So rather than take, a $50 profit or a $100 profit, maybe I'll try to nurse it a little bit further. And let's say I get a $200 winner. Okay, so now I'm down $400. I've got my 3 trade quota, but I'm still in the red, so I'm going to take another trade. So even though this is trade number 5, I'm going to try to take another trade. Again, get into the black. And let's say I take that trade and it's another $200 winner. Well, now I'm down $200. If I run out of time, okay, I finish the day $200 in the red. It's not a deal breaker. If the day goes poorly and I can't find a winning trade to save my life, I do have a pain threshold where I will pull the plug on my trading. And typically that's 5% of my capital. 5% gives me enough of a chance to earn a profit on a day, but it's not that big of a dent that I can't recover that loss in a day or 2. So let's say the wheels come off, I lose $1,000 or $1,200. Sometimes I'll let it go to 6%. And I say, okay, that's enough. I'm gonna pack it up. Something's not right today. It's either me or it's the market. I don't want to decimate my account where I cannot trade. I have met 2 separate people who have both blown through. One blew through a $20,000 account, the other through a $25,000 account in a single session. Don't ask me how you can do that. I do not know, but they did. 2 separate people. So if you feel you're losing control or you've hit your max pain threshold on the day, just call it a day. Go do something else. Go take it out on some golf balls. Hurl your office lamp across the room. I won't advocate kicking the dog, but kick a pillow. Kick the ottoman. Your objective as a trader is to take what the market is giving. If the market ain't giving, you ain't taking. Simple as that. And you got to pick your battles. So that's a very convoluted and drawn out way of saying I have a trade quota, I have a profit objective, and I have a max loss objective on the day. And again, everything is just framed with the sole purpose of keeping me from doing something totally stupid and blowing myself up. And I like to say half jokingly that I'm a fairly clever fellow. I've figured out a lot of ways to lose money. So, I don't want to make things harder than they already are. But that's a great question, Steve, and a good way to finish off today's session. All right, DTS owners, I will see you in the trading room again tomorrow morning. And just a reminder, we'll have another open house next Wednesday if you would like to join us again. I would love to see you there. Enjoy your comments, and you've got my email if you would like any more information. All right, we'll talk to you tomorrow. Bye for now.